Look at this crowd. Over 83,000 people packed into a single stadium. And that is only the physical footprint. Globally, billions of people pause their daily routines to watch a World Cup match. When human attention consolidates on this scale, consumer behavior shifts immediately. Money that would normally flow into routine expenses like groceries or home improvements suddenly pivots toward entirely new industries. For an investor, this creates a specific challenge. You have to decide whether to attempt to capture this temporary spending surge or ignore the noise to protect your long-term capital. This chart shows the disconnect that occurs during the tournament. Notice the sharp peak in consumer excitement, while the line for a company's fundamental value remains flat. That gap represents the speculator's trap. Retail investors often mistake a 4-week hype cycle for permanent corporate growth. Recognizing that this excitement has no bearing on a company's underlying value is the only way to navigate the volatility of these events. There is a common misconception that global sports tournaments create new money for the economy. They do not. What we are actually seeing is a redirection of existing capital. The total amount of consumer spending remains relatively stable. It is simply moved from one sector to another. A family might delay a major purchase or an investment contribution to cover the costs of travel, tickets, and hospitality. Routine sectors lose demand, while event-linked sectors gain it. To protect a portfolio, we have to map where this money actually flows, identify where the market quietly loses efficiency, and determine how to position your assets accordingly. Navigating this window requires looking past the highly publicized headlines to understand the reality of market redirection. The most obvious beneficiaries are the brands fighting for visibility. Corporations allocate significant advertising budgets to secure digital placement in front of a captive global audience. Media networks, streaming platforms, and data analytics firms convert this viewership into higher short-term quarterly earnings. For these companies, the tournament provides a concentrated revenue window. However, professional analysts calculate these revenues months in advance. By the time the first match begins, the expected financial gains are usually already reflected in the stock price. Beyond the screen, the retail sector sees a temporary surge in volume. Merchandise, team apparel, and fan gear move off the shelves at an accelerated rate as the tournament progresses. This spending extends to local hospitality. Restaurants, bars, and fast food chains see a significant increase in foot traffic as fans gather for viewing events. This matrix shows how different sectors compare. While media and retail see clear surges, they also carry a high post-event crash risk. Once the excitement fades, these consumption levels normalize almost immediately. Buying these winning stocks during the tournament often means you are purchasing at the peak of a sentiment-driven rally rather than on fundamental strength. To understand the full economic picture, we have to look away from the bars and broadcasters and toward the sectors that are quietly losing output. Millions of employees worldwide shift their attention away from their professional tasks to follow live matches during work hours. When matches are watched on company time, it translates into slower business output and reduced operational efficiency. This widespread distraction creates a subtle drag on industries that have nothing to do with sports. While the entertainment sector gains, the broader industrial and service sectors often see a dip in performance. This quadrant chart illustrates the divide. Media and advertising are highly visible with a high impact. But in the lower quadrant, productivity loss is nearly invisible to the public, yet has a clear negative impact on broader economic data. When you account for the lost output across unrelated sectors, the net economic gain of the tournament is often much smaller than the headlines suggest. It is an exercise in redistribution, not total growth. There is also a specific risk regarding market mechanics. When major matches begin, institutional professionals often step away from their terminals. This results in lower trading volumes and decreased market participation during game hours. As the stream of trades thins out, liquidity drops. In a low liquidity environment, even small trades can cause erratic price movements, making it much harder to manage risk effectively. This technical risk is compounded by a psychological one. The high emotions of the tournament can trigger a fear of missing out, leading investors to make impulsive decisions they would normally avoid. Combining emotional impulsivity with thin market liquidity creates a dangerous environment for any retail portfolio. To navigate this, choose a clear lane.
A speculator attempts to capture momentum. This requires entering before the event, utilizing stop losses, and exiting as the hype peaks. A strategist protects capital. This involves ignoring sector noise, focusing on fundamentals, and missing temporary rallies. If you play the speculator's game without the time or tools to monitor volatility, you will lose your capital to more disciplined traders. Neither strategy is wrong, but mismatching your approach to your actual capacity for risk is a guaranteed way to suffer when the market corrects. The final reality check is simple. Major sporting events influence sentiment, not the structural core of the economy. When the final whistle blows, the excitement fades and advertising budgets return to normal. Stock prices that were inflated by event-driven hype often correct shortly after. While others are reacting to the noise and trading on adrenaline, a disciplined investor stays focused on fundamental earnings data and long-term trends. Audit your current holdings for assets that are being propped up by temporary hype. If you want more reality-based market analysis, subscribe to the channel. Success during the World Cup doesn't depend on which team lifts the trophy. It depends on maintaining your discipline while everyone else is distracted.